Hi, Rob D here. Welcome to this bonus episode. This was originally broadcast back in June last year, and we're dropping it back into your feed today for two reasons. Firstly, because it goes perfectly with yesterday's episode about whether property really does double every 10 years. And secondly, because Rob B really wanted to hear the Back to the Future music on the podcast again. So we're looking at how to use the past to predict the future when it comes to property prices. This is basically a case study in what happens when you're obsessed with property and you don't want to do whatever work you're supposed to be doing at the moment. This came out of Rob B's procrastination. Rob B procrastinated and the rest is history. Boom, boom.
Oh.
So what he started doing was looking at the past regional data from the Nationwide Price Index. So as you'll probably know, the Nationwide puts out an index every quarter showing what's happened to property prices. There are others available, but Nationwide is a popular one and it goes back a long way. It shows you the UK figure and it gives you a regional breakdown, and it's the regional part that Rob started getting interested in. The reason that we wanted to dig into it and pull out the findings for this episode is that a lot of people ask us about London and what's happening with regard to London and the 18-year property cycle. So if you're not up to speed with the idea of the cycle, we're going to link to an episode about that in the show notes, which you'll find at thepropertyhub.net/history. But hopefully you are aware of what the 18-year property cycle is. London often looks like an anomaly. People often ask if it's in a cycle of its own. Is it not following the same cycle as the rest of the country? The data is a really useful guide to see if what's playing out now with London's really rapid price rises is a new phenomenon and it's on a cycle of its own, or if it's a pattern repeating itself. And the results, I think it's fair to say, surprised us both.
It really did, hence the podcast. So, how we approach the data, because I think that's important. Well, as Rob said, we used the Nationwide Price Index, and we started looking at the numbers from 1989, which was the last property major crash. And that cycle ran for, would you believe it, 18 years to 2007. So we're looking at the last 18-year property cycle. And specifically, we looked at London versus the Northwest and Yorkshire and Humberside, because we looked at those two regions versus London, because those regions are what's considered today as the modern-day Northern Powerhouse. Of course, that term didn't exist back then, and not as much regen occurred back then, although certain cities did well, Manchester and Liverpool, for example. But we thought it'd be really interesting to compare those regions specifically.
Okay, so let's look at what we discovered. We're going to talk in a bit about what it tells us, what it means, and what you should do as a result. But let's start by just looking at the data itself. So let's go back to the 1989 crash. In the immediate aftermath of that, the market dipped, and the market stayed low for 4 years, with the majority of that loss happening in the first 18 months. So even though there were 4 years of prices falling, most of it happened in the first 18 months, although there was a really sharp fall, and then it just drifted downwards from there. It was a similar story after the 2007 crash, so the next cycle along. The market fell for 18 months, but then started to gradually recover, with London starting the strongest.
I think that's really interesting, Rob, that, we said 18 months, I think it was exactly 5 quarters both times round. Just that being the same in itself is really fascinating, because we're going to come to lessons later, but it kind of gives us confidence of when to get moving next time round after the crash.
So let's move on to see what happened after that crash. Things started picking up again, and then you'd expect to come to the mid-cycle wobble. That's what their cycle tells us is there. For the previous cycle, the mid-cycle wobble occurred in the year 2000, so that's 11 years after the crash itself. As you might remember, in 2000, the stock market crashed after the tech bubble burst. That was a really big deal back then. We were fairly young at the time, but I remember that happening, and the market fell in the US especially from enormous heights. Interestingly, the property market only dipped for 1 quarter, and the UK didn't go into a recession, probably because interest rates were cut to stimulate things. So big stock market crash, but only a small dip for 1 quarter in the property market.
Okay, so the bit you're waiting for, the numbers. So first of all, let's go back to the 89 cycle. And we're going to look at from the 18 months in, from when most of the dips have happened, up until the mid-cycle wobble. So we're towards the end of that period now in our cycle. So let's have a look what happened. So Yorkshire and Humberside, in that period, was up 16.59%. The Northwest was up 20.1%, with London up a whopping 85.1%. Last time, just to repeat, in the last cycle, the North and Yorkshire, quite slow in the cycle, no major growth, and then London just powering away. Sounding familiar to anyone? But let's carry on. If you're wondering what's happened this time, we're only 8 years into that period, whereas that was just over 10 years. But actually, it's spooky how similar it is. So this time round, Yorkshire up 16%, the Northwest up 16%, and London up 97%. So although not exactly the same numbers, and we're at a slightly different point, but close to it, very, very similar patterns. And that's when I started to get excited, because we started to realise that this isn't a new phenomenon. This has happened before.
Well, yeah, you say that it's not exactly the same, but it's really, really similar. You've got exactly the same growth up in Yorkshire, Northwest very similar, London a bit more aggressive this time, but that theme of London running away is still there. So then you think, well, okay, so if the first part of the cycle is similar, well, maybe the second part will be as well. So let's see what happened there.
Okay, so we haven't had our second part of the cycle yet, so we looked to the 89 cycle again. And in the years from 2000 to 2007, the second half of the cycle, which is the most aggressive part, London up 110%, still very good. But this time, the Northwest, 146%, and Yorkshire, the worst performer in the first half, up 165%. So if you got into Yorkshire around the mid-cycle wobble, your prices would have more than doubled and another 65% in those 7 years, which is incredible, absolutely incredible, huge growth. So it kind of shows you it was undervalued in the first half of the cycle, but it more than made up for it in the second half of the cycle.
All right, I love this stuff. I love looking at the regional breakdown. I always look at regional stuff a lot because I feel that so many stats and so many headlines report the UK. And when you look at the average like that, it obscures so much interesting stuff going on below the surface. And I think this is a fantastic example of that. So what does this tell us then? That's pretty striking data, but what can we do with it? Well, let's start by talking about the timing of the wobble. If the same timing occurs for the mid-cycle wobble, then we're due for it in 2019. But it's unlikely to be exactly the same. I think you can expect it anytime over the next 2 years. That seems reasonable. There are definite signs that it's approaching right now, and so roundabout in the right ballpark in terms of timing. When that does happen, how worried should you be? Well, not very. If a recession happens, then history tells us that it's likely to be brief. So a stock market crash seems very likely. I mean, you can work that out just by looking at its current values and its current fundamentals. But history tells us as well that a stock market crash is likely, but that doesn't necessarily mean that property prices are going to crash along with them. It's likely that any falls in the property market are going to be relatively mild and relatively short-lived.
Absolutely. Last time round, it was 1 quarter, so nothing to start crying over. And then, as we said, the aggressive stuff happened. What else does it tell us, though? Well, London, like this time, started strong and was absolutely the right place to invest after the crash. There's no question there. But then the smart money, if you'd seen what happened last time, would have moved from London into the north, the Northwest and Yorkshire both outperforming London. And I think we knew that the UK as a whole went through cycles. We've talked about it enough. And then we've made assumptions that the North will go because of the values there. And we've talked about this a lot, but we hadn't gone into the data. That was just common sense principles to us. It was money moving, value moving, stuff being overvalued and stuff being undervalued, and it just making sense that money flows that way. And that's how we made our predictions about Manchester and why we've made them about Leeds and Liverpool. But it was all based on just common sense principles and basic economics. What's really, really interesting is that actually what we've assumed is the common sense stuff actually played out last time. And this data conveniently is also, Rob, backs up that theory that we've had. And it's such an important point that the media will always focus on the UK wide and particularly weighted to London. So looking at this regional stuff actually gives us, and so should you, a lot of confidence.
Yeah, exactly. I was really surprised by looking back at how strongly London grew last time round. I really thought that the extent to which London had kicked off in the first half of this cycle was abnormal. And you can see lots of reasons for that. You can sort of look at it being as a safe haven for international money after the last crash and all these things. You can paint all these reasons why, particularly this time, it was strong. But it turned out it was pretty much exactly the same last time as well. So to answer the question that we posed back at the start, London is not on its own cycle. It seems that London just picks up the most strongly, has most of its growth early, and then it performs weaker than other regions later in the cycle. So it's almost like the two phases are reversed. It has its aggressive growth early and its milder, but still pretty good growth later on. So all really interesting, but what should you do with this? Well, first up, don't worry about the wobble. So the wobble is coming. We know it is. The cycle tells us that it should. We could see it happening last time, and we can see from last time that it was pretty mild. It might not feel like that though, because the media will have a field day and the stock market will probably crash. But in property terms, it's probably not going to have all that much of effect. That's why we call it a wobble rather than a crash or anything like that. It's so important at times like that to hold your nerve, because the headlines will be apocalyptic and the natural reaction will be to sell at that point. But that is the absolute worst thing that you could do, because as the cycle also shows us, the best is yet to come.
So if you're heavy in London now, you'll still do okay. You'll still do fine. It's not like you're going to lose all your money. And I know we often say, I wouldn't invest in London right now. And it's not because we don't believe it as a place. We will invest absolutely in London in the future. But the value is elsewhere right now, and that's why we're there. And when the value isn't there, we'll move back to London. But if you are heavy in London right now, it may be worthwhile considering the north, so places like the northwest and Yorkshire and Humberside, and looking at those places because there's a lot of value there right now. Look at how little it's moved so far, and look at what it did last time. It didn't move at all at the beginning, and then went really, really strong in the second half. So put it on your radar. I'm not saying sell your London properties to go and fund it in the north. Far from it. Just if you're going to carry on, maybe carry on somewhere else. And then, Rob, conveniently, we know what to do exactly after the next crash in 2025. We'll both wait 18 months. We'll invest in London, and then we'll be rich. Okay, maybe it's not that exact science, but that actually is roughly what we'll probably be both doing. You know, we'll look at London then, because it should be value again after another correction, and then it'll all start kicking off, and then we'll move from London into the north like we've done this time. So like I said right at the beginning, history doesn't repeat itself, but it does rhyme. It's Mark Twain, by the way. It's not my inspirational quote. And that really, really is shown here through the property market and cycles. So the 18-year property cycle is something we've got very excited about before. And as I've said, we've looked at it on a UK level. But this now, if I wasn't sold on it before in terms of what's happening and what's going to happen, I've got so much comfort out of this. Yes, it's not exact science. We're not claiming it is. But I'd say it's a very good guide.
Yeah, I'd say so. And yeah, you're quite right. All normal caveats apply. And we've only looked at the one cycle in the past and blah, blah, blah. But from what we've already seen in this cycle, the similarity seems to be there. And it should really give you confidence. And a point that I think is really interesting as well is the fact that the majority of the losses in the previous crash took about 18 months. So there was 18 months of real sudden falls. And then it just kind of like drifted downwards a little bit before it bottomed out and started coming back up again. I think knowing that will really give you the confidence to invest at the right time next time. Like you said, Rob, wait 18 months from the last crash and then invest in London. Not necessarily exactly, but at that time, 18 months after the next crash, it's going to be a really scary time to buy. Most people aren't going to be doing it because there's all this worry about, okay, well, prices have been falling. If I buy in now, then they'll just continue to fall further. And that's why people aren't buying. And that's why it takes so long for prices to finally bottom out and recover. But that is precisely the right time to be buying. That time, 18 months in, it's the best time that you could possibly be buying. It's a time when no one else is. It's the absolute hardest time to be doing it, which is why no one else is. But this data could give you the comfort to go against the herd and to do that. So that's where I think this isn't just an interesting intellectual exercise by a couple of guys who like spreadsheets. It's actually going to allow you to do what you need to do and kind of know you need to do, but are scared to do.
Absolutely. Like you said, Rob, it'll be scary to invest in London after 2025. And for a lot of people right now, it'll be scary for them to invest in the North because they haven't seen the growth. And it's hard for people to do stuff that bucks against the current trend. Oh, it's only grown 20%. I'm not going to invest there. But like you say, that's where the value is. And it's funny, we were talking about stocks before the property podcast, which is a rarity for us, but it's because we were talking about the market crash that's likely to come. And we were both talking about our strategies, what we're going to do after the crash, because we know that's an opportunity. And it's like before a boom, now's an opportunity.
So there you go. Hope you enjoyed that bonus episode. We will see you again on Tuesday for Ask Rob and Rob. Bye-bye for now.